Are you one of those people out there that hates annuities? Well, I'm sorry, but 380 something billion dollars was sold in annuities just last year, and it was all from individuals, no institutional money. So they're becoming extremely popular. And honestly, there is a reason. So let's go through what happened in the last year or two. The first thing is look at these numbers. 385.4 billion with a B in new premiums by individual investors in 2023. Now, the big winner was the fixed annuities, and there's a logical reason for this, okay? The fixed annuity world comes in four different types in this case. $164.9 billion in MYGAs, multi-year guarantee annuities. I'm going to highlight those next, but the reality is these are just CDs from insurance companies, and people have finally woken up because these have always been better than CDs at a bank. And honestly, for the last 20 years, they've all been better than individual bonds as well. Then you got $95.9 billion worth of fixed indexed annuities. Okay. And this is because the independent advisory world is finally waking up as well and utilizing these as safe investments for retirees. Then you've got those immediate annuities, 13 billion, 4 billion in deferred income. That's a dinner seminar annuity. Think about that. That's such a small fraction of our universe. I live in Arizona. It feels like that's what, everybody's selling out there. But boy, it has shrunk to a tiny little portion of the greater annuity world. And then variable annuities keep declining and declining. The traditional variable annuity is down to 51 billion. This used to be the top form of an annuity because all the big brokerage houses, they all were using these to make some wonderful fees, unfortunately, because these risk-based annuities do have lots of fees in them. But the new type of variable annuity is called an index-linked annuity, different than the fixed indexed annuity, because these actually have risk. They just define the risk. Okay. So the whole category was only 98 billion out of 385. So I grabbed the top two types to show you why these things have changed. So looking at the next slide, it really does highlight the basic logical reasons. The increase in the fixed deferred annuity sales is attributed to higher interest rates is the first reason right there. There's an obvious reason when you see these multi-year guarantee annuities, they're the best fixed rate investment out there right now, period. Demographic trends, well, just the sheer number of retirees that have money. The baby boomers are retired. Paul Revere was running through the streets. The baby boomers are coming. The baby boomers are coming. And they already came. They're here. The richest generation is retired. And then we're going to have the great transition to the kids. And that's just going to throw away all the money after that. The risk in the bond market. Well, everybody in 2021, 22-ish lost about 20% in their bond portfolio. And they're finally realizing, they're paying attention. They actually went and looked at the tickers and looked at the bonds that they owned and realized for 20 years they've made nothing. They're negative returns. You're making nothing in these bonds. They're a return-free risk. When we have inflation, you will lose money in your bonds. People are finally realizing that. You can look back on my videos since before that. You can even find me saying bonds are a risk for retirees. You should not be in them. If we see inflation, before we saw it, if we see inflation, you're going to lose money. We got to transition out of these bonds. Retirees' general desire for safe investing options. Look, let's be honest. A lot of retirees lose their taste for the market. Some of them, it increases. It's always nice. I always love it. Oh, I made, 20% last year. Well, did you forget the 20% you lost the year before? You haven't even broke even yet, by the way. So some people focus on the good years. Some people focus on the bad years. But all in all, on average, retirees are seeking safer investments. And there's that overwhelming feeling that something's coming, right? Independent financial advisors are stripping away their biases because they know that bonds are in a bad position. And they don't have a big company telling them you have to keep using bonds. That's the problem. These big, huge, enormous conglomerations of advisory firms, they all make tons of money on the bond market. So we have to be careful about that advice. It's economics. We have to know that as the interest rates rise, the value of bonds goes down. And every time we're going to see inflation in the United States, the Feds are going to use their playbook that says raise the interest rates. And you're going to lose money when we have inflation. And you shouldn't be doing that in retirement without question. So be careful about this. Independent advisors are finally getting their eyes opened, right? We have a younger generation coming in of advisors. The old guard is starting to retire and head off. So we've got these advisors that don't have as much biases. And that's important. And that's why we're seeing such a huge increase out there. So let's look at the top two categories. Number one, multi-year guarantee annuities, MYGAs. That's what we call them behind the scenes. These have always been better, but there's a reason that your advisors never will give these to you. They can't make enough money for them to stay in business. Yes, that's right. Oh, the commissions, they pay commissions. They're big commission. No, they're 2 or 3% commissions. And if you're over 80, they're more like 1% commissions. And that's upfront, and that's not annual. So think about it like this. An advisor puts you in a bond fund and charges a management fee. A lot of these advisors will take commissions from those bond mutual funds and individual bonds. And then on top of that, they will charge you a management fee on average, let's say 1% a year. Well, over 5 years, they're going to make 5% plus whatever commissions they got from your money. In a multi-year guarantee annuity, you get 5 years fixed at right now, you can get 6.15 on simple interest and 5.6 on compound interest. Talk about the difference in another day or another video. But the reality is the advisor gets anywhere from 1 to 3% commission upfront from the insurance company, not from your money. So important. And everybody, oh, there has to be hidden fees. No. Are there hidden fees when you go get a CD from a bank? Because it's the exact same structure. The bank invests your money however they want, and they pay you the interest. Thanks for letting us borrow your money, because that's what this is. The insurance company does the same thing. Thanks for letting us borrow your money. Here, we're paying you interest, and they're guaranteeing it for this period of time. Multi-year guarantee annuities are CDs from insurance companies. There's no games here. Banks sell the most of these, believe it or not. There are times when the interest rate fluctuations happen that banks don't want to write CDs. They'd much rather write these. And banks historically have written the most of these because they're not, trying to gouge and make huge fees. So the reality is that, yes, look at this. 7 years, 6%. Sorry, my head's in the way. There we go. 7 years, 5.55 on compound interest, simple interest 6.1, 10 years, 5.6. A few months ago, this was 6%. Locking in guaranteed 10 years at 6%. Oh, by the way, you do your own study of this. Go back and look at the S&P 500 from 2000 to today. You could even go back to 1990 to today. You're going to get pretty darn close to a 6% average in the S&P 500. That's right. Oh, but I just made 20, 30%. Well, that's great, but don't forget all the down periods too. It averages more like 6% if you go back to the modern stock market. You want to go back all the way to the beginning of time and say, well, it says 12%. BS. Sorry, we've digitized our stock market. We can hit a button and buy and sell big blocks, and we don't have to call somebody and have somebody run out on the floor and go like this. Our market is fundamentally different since about the turn of the century, 2000. 6% is about what the S&P average is, depending on the time period you look at. You look at a long enough time period, you're going to be about 6%. Guaranteeing 10 years at 6% was pretty darn wonderful. Now we're at 5.6. We pulled back a little bit, but we still have some 6% here, especially if you're using your money. Withdrawing it, simple interest is perfectly fine. If you want it to sit in there and grow, then you want the compound interest. Well, why else are these better? Well, they're better than CDs for one very easy reason for retirees. You have access to this money. You're allowed to pull out up to 10% of the account value every year, and it refreshes on every anniversary. Okay, we've always had higher rates than CDs in here. Go check CDs right now. You won't get anywhere near these interest rates. You're about 1% higher right now. Okay, most of the insurance companies issue them at 5 years, 7 years, and 10 years. You get all these offshoot years. You can get 2 year, you can get 3, 4, 6. You can get all the in-between years, but there's only 1 or 2 insurance companies that are issuing them. Not much competition, not very good rates. And then there's, again, no fees and no risk. So think about going and buying a individual bond. Show me an individual A-rated bond that's going to give you this yield. Okay, then I want you to remember, when interest rates rise, you're going to lose value. So the only reason you would buy the bond is because you're speculative and you think the interest rates are going to fall and you're going to sell it when they do fall to make an extra profit. It's the only reason you're going to tell me that those are better than these. Bonds pay simple interest. Simple interest. So important to remember. You can't compare a bond to 5.6 compound interest, especially 5 years or longer. You go all the way out 10 years, 5.6, you're going to have to go find a CD or a bond paying closer to 7% to compare to 5.6. It's pretty crazy, the difference, especially over 10 years when you compound interest. Okay, this is a fixed interest rate for a fixed period of time. Most of these out there are compound interest. It's just right now we have an insurance company out there, a rated insurance company, paying 6% for simple interest for those of you that are actually pulling the money out and using it. Best safe investment out there right now. Best fixed rate safe investment out there right now. That's why these are being sold like hotcakes. They're better than CDs. They're better than bonds. You tell me. I mean, I'm happy to have that conversation with anybody. These are way better, and that's why they're being sold so much. But the problem is there's still so many advisors out there that won't use them in their practice because they don't make enough money and they'd rather have you in bond funds or sell you higher commission stuff. That's the reality of it. The second highest most sold annuity out there last year, again, breaking all the records, are fixed indexed annuities. And yes, I am a fan of these. I think these with fixed annuities, with those MYGAs that I just talked about, can create a very strong, safe invested portfolio. Whatever allocation you traditionally would have put to bonds, I would be using these things for them. I don't have a problem with these. These and the MYGAs, a combination of the two creates a wonderful, and honestly, right now, the best safe portfolio out there. The difference is we have flexibility in a fixed indexed. We still get a fixed interest rate, but we also have other ways to earn interest, and we can earn interest based on how the stock market does in a year. And that becomes very important for a conservative investor, a safe investor, somebody who wants the majority of their portfolio, more than 50% of their portfolio in safe investments. They don't want to have all their money in the stock market. When you start transitioning to these much more conservative portfolios, the fear is keeping up with inflation. And a flat interest rate is not an ideal investment to keep up with inflation. We want something more flexible. So the way these things work, when you get a contract that is a fixed indexed annuity, it spells out how they pay interest. Okay? So they will tell you that we will tie an interest payment to you based on the S&P 500's multi-asset index, not the standard S&P 500 in this case. Or Fidelity has this index called the multi-factor, another multi-asset index. And then BlackRock, this one happens to be that socially responsible index. And again, you're not investing in the socially responsible. You're just getting paid on how that index does. And it's fallen out of favor, but the performance still seems to be pretty darn good these days. So look at these. So I ran the scenarios just in recent history, 16 to 22, and you look at these years and you see these reds. It's so important to understand that by regulation, a fixed indexed annuity cannot have risk. to your principal ever. So when the market goes down, they pay you nothing. When the market goes up, they multiply it. In this example here, it's called a participation rate. Many of you have heard caps and you hate them and you don't like caps. And well, there's plenty of wonderful things out there that don't have caps, that aren't sold at dinner seminar annuities. They are literally built just to grow your money safely. That's it. The only people using these are the independent advisors, and they're using them to replace bond funds, bond allocations in portfolios. And honestly, those of you that are super conservative using too many CDs, you should be using MYGAs, but you should be adding some of this to help you keep up with inflation. So when the market's doing really well, look at that participation rate. It's more than 100% of the stock index. Well, that's because this is a low volatility index. They have controls over the volatility. If the volatility in the stock market heats up, they're moving to cash and treasuries. An index doesn't ever own anything. It tracks the value of things. That's it. So it can shift seamlessly, okay? So the S&P's multi-asset, not the S&P 500, has a more stable environment, a lot less volatility, but they're willing to pay you 190% of whatever that does. Okay, so when it's up 4, they got to pay you 8. When it's up 10, they got to pay you 20. When it's down, they pay you nothing. That sounds too good to be true, but if you knew options trading, that's what they do to protect themselves. Their core portfolio is in corporate lending. They buy big blocks of bonds directly from the issuers. And they are making 7, 8, 9% in their portfolio. Okay, that's wonderful when they have to pay you nothing. If the stock market goes down and they pay you nothing, they made lots of money. If they have to pay you 20%, yeah, they probably broke even that year on your investment. That's about it. They protect themselves with the options trading, and that's it. So they love the years like the more recent years where, you got paid little to nothing when the market wasn't doing well. They get paid plenty, right? So my most important thing I can convey is that you have safety in these. You have no fees in these. You have a flexible way to earn interest. Sometimes you'll earn 0, sometimes you'll earn double digits. You can put 50% of your money in this and 50% in the fixed rate because they do give you a fixed rate option. And then every year you get to change your allocation. You can put 25% in each. You can put it all in the fixed rate. You can put it all in the BlackRock ESG. You could do anything that you want every year. What has changed, and the reason these may have a stigma out there, is that they were allowed to change their interest rate calculations after the first year. And that was terrible. So yeah, they sell it to you based on 190% participation rate, and that all looks wonderful. But then next year they can move it down to 150, and then next year they can move it down to 50. And same thing for the fixed rate. Might start off at 4.5, but they can bring it down to 3, then 2, then 1. Well, guess what? With these higher interest rates, yeah, they're offering these up with guarantees that they won't change for the entire contract duration. So there's 2 companies out there right now, and I was hoping all the others would follow, but there's 2 out there right now that are guaranteeing them for the entire period. So you don't have to worry about the 190% calculation changing. You don't have to worry about the 4.5% fixed rate changing. You don't have to worry about those things. Now, most people didn't realize it was happening, or maybe they don't know why they don't like these things. And that was probably the reason. That was the one flaw in these fixed indexed annuities. And they have fixed that. At least 2 companies have fixed that out there right now. The other cool thing is your earnings are locked in, right? They pay you. If you earned 8%, you earned 8%. Next year, if the market crashes, they don't take that away from you. Your earnings are locked in every single year. Whatever they owed you on the calculation, they have to pay it into the account. There's no risk and no fees. You have access to 10% of your money. 100% of the account goes to your heirs. If you pass away, there's direct beneficiary designations on all annuity contracts. The money moves directly to the heirs without penalty, without any delay. So both fixed and fixed index, both the MYGAs and the indexed annuities, your principal and credited interest is guaranteed. Your money grows tax deferred and compound usually, except the caveat of that simple interest product that's out there right now with the higher interest rate. You have access to your money through penalty-free withdrawal provisions, usually 10% a year. 100% passes to heirs upon death. They're creditor and lawsuit protected. You could die with $1 million in medical debt and this money still goes to your heirs. No fees, okay? I'm sorry, you can argue with me all you want. There are no fees in this. Nobody is taking money out of your principal in the ones that I'm talking about here. And we're seeing an enormous migration from those bond funds to these things. So what's unique to that fixed index side is market-based growth without risk of loss. Multiple ways to earn interest, including a fixed interest rate. Okay, and we can change how we're earning interest every year. That gives us more flexibility as the future comes at us. So that is much better. Now, again, I like both the multi-year guarantee annuities and the fixed index. The mix of the two tends to be the best and most flexible way to safely invest right now. Look, 20 years ago, I want you in a bond portfolio. I have no problem with bonds, but I understand economics. Bonds and bond funds make no sense. Okay, I can see limited uses of them here and there for unique circumstances, maybe some municipal bond portfolios for people that need the tax advantages of it. There's certainly reasons for them out there. I don't have a problem with them. It's just as an investment for people heading to retirement or in retirement, bonds are out. They shouldn't be invested in. As we're floundering around these low interest rates, if you think we're high right now, go look at history. We are not. We haven't even tipped the scales. If we see more inflation, you better bet we're going to keep raising interest rates. People think that's going to break things, and the feds are going to say, yep, I'm an arsonist and a firefighter. I'm going to create my own work. They don't care. So please understand that there's a reason that these became so popular over the last couple of years. They are legitimate. They are real. They do perform. They are currently the best safe investments out there, and that's why billions and billions and billions of individual investor dollars have gone into these in the last couple of years. All right, I hope that helps. I know I yell a lot. I get on my pedestal and talk a lot. All right, if you need me for anything at all, even just want to meet and greet or whatever, yourinvestmentcounselor.com, jump on that little website. You can schedule an appointment with me anytime you want. Full classes. I do full form classes live in person. Always happy to have people jumping on there. FPFEAZ.org for the full schedule and a recording of the class of the month on there as well. And then certainly give us a call if I can help out in any way. If you haven't subscribed, please subscribe. I put new videos on every single week. At least I try to. And I still got plenty more ideas lined up. So keep them coming. Share this with friends, make comments below. Let's have some fun with these videos and let's share it as much as we can. Thank you. We'll see you next week.